Hello and welcome to our comprehensive guide, Understanding the Basics of Gold Investment in the U.S. Over the course of this series, we will embark on a journey to demystify one of humanity's oldest and most prized assets, gold. Before we dive in, it is absolutely essential that we establish the purpose of this series. The information provided here is for educational and informational purposes only. It is not intended to be, and should not be construed as financial, investment, legal, or tax advice. We are not financial advisors, and this content is not a solicitation or recommendation to buy, sell, or hold any asset. All investments carry risk, and you should always conduct your own thorough research and consult with a qualified and licensed financial professional before making any investment decisions. Your financial situation is unique, and any actions you take based on the information presented here are solely at your own risk. With that important understanding in place, let's begin. So, what is it about gold? For thousands of years, this gleaming yellow metal has captivated civilizations. It has been a symbol of power, wealth, beauty, and divinity. From the tombs of ancient Egyptian pharaohs to the vaults of modern central banks, gold has maintained an undeniable allure. But why? What gives this particular element such an enduring legacy and a persistent role in the modern economy? To understand gold's place in today's world, we must first look to the past. Its history is deeply intertwined with the history of humanity itself. Long before it was an asset traded on a stock exchange, it was currency. Ancient civilizations, like the Lydians in modern-day Turkey, are credited with creating the first gold coins around 550 BC, standardizing trade and transforming commerce. The Roman Empire used gold extensively, funding its legions and its vast infrastructure with coins like the aureus. Throughout history, gold's value was rooted in its perceived stability. When empires fell, their paper currencies often became worthless, but the gold they held retained its value. This historical precedent is a key reason why the concept of the gold standard emerged, a monetary system where a country's currency value was directly linked to a specific quantity of gold. The United States, for much of its history, operated on a form of the gold standard, which only officially ended in 1971. This long history as the ultimate form of money has embedded a deep-seated trust in the metal, a trust that persists in the minds of many to this day. Beyond its history, gold possesses a unique set of physical properties that make it exceptionally well-suited as a store of value. First, it is incredibly durable. Gold does not rust, tarnish, or corrode. An ounce of gold recovered from a 200-year-old shipwreck is, for all practical purposes, the same as an ounce of gold mined yesterday. It is virtually indestructible, meaning that almost all the gold ever mined in human history still exists in some form today. Second, gold is rare, but not impossibly so. Its scarcity ensures that it has inherent value, unlike common metals such as iron or copper. If all the gold ever mined were collected, it would form a cube roughly 22 meters on each side. This finite supply means its quantity cannot be arbitrarily increased, which stands in stark contrast to fiat currencies, which can be printed by central banks at will. Third, gold is highly divisible and malleable. It can be melted down and reformed into bars, coins, or jewelry of various sizes without losing its intrinsic quality. A 1-ounce coin can be melted and made into 2 half-ounce coins, and their combined value remains the same. This makes it practical for trade and storage in various denominations. These physical characteristics and its deep-rooted history are what lead many to consider gold for several key roles within a modern financial context. One of the most frequently discussed roles is as a potential hedge against inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power of a currency is falling. The theory is that as the value of a currency like the US dollar declines, the price of gold, when measured in those dollars, tends to rise. Because its supply is relatively fixed, it is perceived by some as a more stable store of value over the long term compared to currencies that can be devalued through monetary policy. Another common perception of gold is that of a safe haven asset. During periods of economic turmoil, geopolitical instability, or significant market volatility, some investors tend to move away from assets they perceive as riskier, like stocks, and toward assets they believe will hold their value. Historically, gold has often been one of those assets. The thinking is that because gold is a tangible, physical asset with no counterparty risk, meaning its value isn't dependent on another party's solvency, it provides a sense of security when other financial systems seem fragile. Finally, gold is often discussed in the context of portfolio diversification. Diversification is the strategy of spreading your investments across various assets to reduce risk. The principle is that if one asset class performs poorly, the others may perform well, balancing out your overall returns. Historically, the price of gold has often moved independently of, or even inversely to, the prices of stocks and bonds. For this reason, some investors choose to allocate a portion of their portfolio to gold, with the goal of adding a layer of stability that is not directly tied to the performance of traditional financial markets. It is crucial to remember that these are theories and historical observations, not guarantees of future performance. Gold's price can be, and often is, volatile. It does not pay dividends or interest, and its value is purely determined by what someone else is willing to pay for it at any given moment. In summary, the fascination with gold is not a recent phenomenon. It is a legacy built over millennia, founded on its unique beauty, its historical role as money, its distinct physical properties, and its perceived function as a stable store of value in an often unstable world. Understanding this deep history and the fundamental reasons for its allure is the first and most critical step in understanding the basics of gold as an asset class. In our next chapter, we will move from the why to the what. We will explore the different forms of gold you can own, from the tangible feel of a physical coin in your hand to the digital entries of a modern gold-backed security. Thank you for joining us. Welcome back to our series, Understanding the Basics of Gold Investment in the U.S. In our first chapter, we explored the deep historical and economic reasons behind gold's enduring allure. We discussed why it has been valued for millennia, and the roles it is often perceived to play in a modern financial landscape. As a reminder, all information in this series is for educational and informational purposes only, and should not be considered financial advice. Investing involves risk, and we strongly encourage you to consult with a qualified, licensed professional before making any decisions. Now that we have a foundational understanding of the why, let's dive into the what. When someone decides they want to have exposure to gold, how do they actually do it? The methods of owning gold today are more varied than ever, ranging from holding a tangible piece of the metal in your hand to owning a digital representation of it through a brokerage account. Broadly, we can categorize these methods into two main groups: physical gold and gold-related financial instruments, sometimes referred to as paper gold. Let's begin with the most traditional and intuitive form, physical gold. This means you are the direct owner of a tangible amount of the metal. There are two primary forms of physical gold that individuals commonly acquire. The first is gold bullion coins. These are not the rare, collectible coins whose value is based on their numismatic rarity. Instead, bullion coins are produced by government mints, and their value is based almost entirely on their gold content, or melt value. Some of the most well-known and trusted bullion coins in the world include the American Gold Eagle, the Canadian Gold Maple Leaf, the South African Krugerrand, and the Austrian Philharmonic. These coins are typically minted in various sizes, most commonly 1 troy ounce, but also in fractional sizes like 1/2, 1/4, and 1/10 of an ounce. When you buy a bullion coin, you typically pay the spot price of gold, which is the current market price, plus a small percentage called a premium. This premium covers the costs of minting, distribution, and the dealer's profit. The second common form is gold bars, also known as ingots. Gold bars can range dramatically in size, from as small as 1 gram to the large 400-ounce good delivery bars held by central banks. For individual investors, sizes like 1 ounce, 10 ounces, and 100 grams are common. Bars are produced by private refiners and mints, and it's very important to purchase them from reputable sources. Reputable bars will be stamped with the refiner's name, the weight of the bar, and its purity, which is typically 9,999, or 4 nines, meaning 99.99% pure gold. Generally, the larger the bar, the lower the premium per ounce you will pay, making them a cost-effective way to acquire a larger amount of gold. Owning physical gold has a distinct set of considerations. The primary advantage is direct ownership. You hold the asset yourself. It is tangible and exists outside of the traditional financial system, meaning it carries no counterparty risk. Its value is not dependent on the solvency or promises of a bank or financial institution. However, this direct ownership also comes with challenges. The most significant are storage and security. You must decide where to keep your gold safely, whether in a home safe or a bank safe deposit box, both of which may have associated costs and risks. You also need to consider insurance. Furthermore, selling physical gold can be slightly less convenient than selling a stock, as you'll need to find a reputable dealer and may have to arrange for secure shipping or delivery. Now, let's turn our attention to the second category, gold-related financial instruments. These provide exposure to the price of gold without requiring you to take physical possession of the metal. Perhaps the most popular method in this category is through gold exchange-traded funds, or ETFs. An ETF is a type of security that tracks an underlying asset, in this case gold. The fund itself holds large quantities of physical gold bars in secure, audited vaults. When you buy a share of a gold ETF, you are buying a share in the trust that owns the gold. These shares trade on major stock exchanges just like a regular stock, making them extremely easy to buy and sell through a standard brokerage account. Well-known examples include the SPDR Gold Shares, ticker GLD, and the iShares Gold Trust, ticker IU. The main advantages of ETFs are their liquidity and convenience. You can buy or sell them instantly during market hours at a price very close to the spot price of gold, and you have no personal storage or security concerns. However, there are trade-offs. You do not own the physical gold. You own a share in a fund. This introduces counterparty risk related to the management and custody of the fund's gold. Additionally, these funds charge an annual expense ratio, which is a small percentage of your investment paid to the fund's managers each year. Another way to gain exposure to gold is by investing in gold mining stocks. This is an indirect approach. Instead of owning gold, you are owning shares in a company that explores for, mines, and produces gold. The profitability of these companies is heavily linked to the price of gold. If the price of gold rises, their potential profit margins can increase significantly, which can cause their stock price to rise even more, a concept known as leverage. Some mining stocks may also pay dividends. However, this approach carries a different and often higher set of risks. You are not just betting on the price of gold. You are also betting on the success of a specific company. The stock's performance is subject to a host of other factors, including the quality of the company's management, its operational efficiency, its debt levels, and even geopolitical risks in the countries where its mines are located. A mining company could face a production shutdown, a labor strike, or a regulatory change that could cause its stock to fall, even if the price of gold is rising. In summary, the ways to own gold are diverse, each catering to different priorities and risk tolerances. Physical gold, in the form of coins and bars, offers direct, tangible ownership free from counterparty risk, but comes with the responsibilities of storage and insurance. On the other hand, gold-related financial instruments, like ETFs and mining stocks, offer convenience and liquidity through a standard brokerage account but introduce different types of risks, such as counterparty risk and business-specific risks. There is no single best way. The appropriate method depends entirely on an individual's own circumstances, goals, and research. In our next chapter, we will delve deeper into the practical steps of acquiring physical gold. We'll discuss how to find reputable dealers, understand the difference between spot price and retail price, and what to look for to ensure you are buying an authentic product. Thank you for joining us. Hello and welcome back. In our previous chapter, we explored the different forms of gold ownership, distinguishing between tangible physical gold and gold-related financial instruments. Today, we're focusing on the practical side of the equation. If one were to consider acquiring physical gold, what does that process actually look like? As always, we must preface this discussion with our standard disclaimer. This content is for educational and informational purposes only. It is not financial advice. The process of buying any asset involves risk and requires careful consideration of your personal financial situation. Always conduct your own thorough research and consult with a qualified professional. When you decide to look into buying a physical gold coin or bar, one of the first things you'll encounter is the pricing structure. It's not as simple as a single price tag. The price you pay is composed of two main elements: the spot price and the premium. The spot price of gold is the current market price for 1 troy ounce of the metal being quoted on global commodity exchanges. This price fluctuates constantly throughout the trading day, driven by supply, demand, currency movements, and global economic events. It represents the price for raw, unfinished gold, and it serves as the baseline for pricing all gold products around the world. However, you will never pay just the spot price. On top of the spot price, every physical gold product has a premium. The premium is the additional cost that covers everything involved in getting that finished product into your hands. This includes the costs of fabrication and minting, the dealer's operational overhead, secure shipping, insurance, and the dealer's own profit margin. Premiums are not fixed. They can vary based on several factors. For instance, a 1-ounce American Gold Eagle coin will typically have a higher premium than a 1-ounce gold bar, because coins have more intricate designs and are minted by a government entity. Furthermore, smaller items have higher percentage premiums. A 1-gram gold bar will have a significantly higher premium relative to its gold value than a 1-ounce bar, because the manufacturing cost is a much larger proportion of its total price. So once you understand the pricing, where would someone go to purchase physical gold? There are generally two types of sources: local dealers and large online bullion dealers. Local coin and bullion shops offer the advantage of a face-to-face transaction. You can inspect the products before you buy, ask questions directly, and take immediate possession of your purchase, eliminating shipping risks. However, their selection may be more limited, and their premiums might be slightly higher than those of larger online operations due to higher overhead costs. Major online bullion dealers have become a very common source. They typically offer a vast selection of products from mints and refiners all over the world, often with very competitive and transparent pricing that is updated in real time with the spot price. The main considerations here are ensuring the legitimacy of the dealer and accounting for shipping time and security. This brings us to a critical point: due diligence. Regardless of the source, evaluating the reputation of a dealer is paramount. This is not a recommendation of any specific business, but rather an educational overview of the characteristics one might look for when conducting their own research. A reputable dealer often has a long track record and a positive public reputation. You can research a company's history and see what kind of feedback they have from past customers through independent sources, such as the Better Business Bureau. Be mindful that online reviews can sometimes be manipulated, so it's wise to look at multiple sources. Transparent pricing is another key indicator. A trustworthy dealer will clearly display both their ask price, what they sell for, and their bid price, what they buy for. These prices should be clearly tied to the current spot price of gold. If a dealer's pricing is opaque or difficult to understand, that can be a red flag. Reputable dealers also tend to be a two-way market. This means they don't just sell gold, they also actively buy it back. A dealer with a clear and fair buyback policy is generally a sign of a stable and established business. They should also have clear, detailed policies regarding payment, shipping, and insurance. When researching, it's also important to be aware of common pitfalls and scams. The most obvious warning sign is a price that seems too good to be true. No legitimate dealer can sell gold for significantly less than its spot price. Such offers are almost certainly fraudulent. Be cautious of high-pressure sales tactics. A professional dealer should provide information and allow you to make a decision in your own time. Be especially wary of any attempts to steer you away from standard bullion products and towards so-called rare or collectible numismatic coins, which are often sold with extremely high premiums that are not justified by their gold content. For someone interested purely in gold exposure, standard bullion is the typical focus. Finally, to minimize the risk of counterfeit products, it is generally recommended to stick with well-recognized, standard bullion products, like the previously mentioned government-minted coins or bars from internationally accredited refiners. In summary, the process of buying physical gold involves understanding its pricing structure, the spot price plus a premium, and conducting careful, thorough research to identify a reputable dealer. It's a process where patience and due diligence are your most valuable tools. By being aware of the characteristics of a trustworthy seller and the warning signs of a potential scam, an individual can navigate the market with more confidence. In our next chapter, we will address the logical next question after a purchase. What do you do with it? We'll discuss the various options and considerations for storing and protecting your physical gold. Thank you for joining us. Welcome back to Understanding the Basics of Gold Investment in the U.S. In our last chapter, we walked through the practical considerations of purchasing physical gold, from understanding pricing to identifying the characteristics of a reputable dealer. Acquiring the asset is just the first step. The next, equally important question is, what do you do with it now? How do you store and protect it? As we begin, please remember that this chapter, like the entire series, is for educational and informational purposes only. It does not constitute financial, legal, or insurance advice. The methods discussed have their own risks and benefits, and you should always conduct your own detailed research and consult with appropriate professionals when making decisions about securing any valuable asset. When it comes to storing physical gold, the options generally fall into three main categories: home storage, a bank-safe deposit box, or a third-party depository. The choice between them involves a personal assessment of the trade-offs between direct control, security, and cost. Let's start with the option that offers the most control: home storage. This means keeping your gold on your own property. The most significant advantage here is immediate and absolute access. You can retrieve your gold at any time, day or night, without needing permission from or access to a third party. However, this control comes with the full responsibility for its security. The primary consideration for home storage is the risk of theft. This makes discretion paramount. It is widely suggested that the fewer people who know you possess physical gold, the better. The other major factor is the quality of your storage container. A simple lockbox is not sufficient. Most sources recommend a high-quality, heavy-duty safe that is both fireproof and waterproof. Ideally, the safe should be professionally installed and bolted to the floor to prevent it from being removed entirely. Another critical aspect of home storage is insurance. A standard homeowner's or renter's insurance policy often has very low coverage limits for valuable assets like precious metals, sometimes as low as a few $100s. If one were to store a significant value at home, they would need to research obtaining a separate insurance policy or a special extension, often called a rider, on their existing policy. This is a specialized area, and understanding the terms, conditions, and proof of ownership requirements is essential. Next, let's discuss a very common and traditional method: the bank safe deposit box. This involves renting a secure box inside a bank's vault. The obvious advantage is a very high level of security against theft. Bank vaults are purpose-built to withstand break-ins, offering a level of physical protection that is difficult and expensive to replicate at home. The cost of renting a box is also relatively low. However, there are important considerations. First, your access is limited to the bank's operating hours. You cannot get to your assets on a weekend or a holiday if the bank is closed. More importantly, there is a widespread misconception about insurance. The contents of a bank safe deposit box are not insured by the FDIC. The Federal Deposit Insurance Corporation insures cash deposits in bank accounts, not the contents of a safe deposit box. The bank's own insurance may also not cover the contents. Therefore, just as with home storage, the responsibility for insuring the contents of the box typically falls on the owner. You would need to look into a separate policy to cover assets held in a bank box. Finally, we have the third option: a third-party depository. These are private, specialized companies whose entire business is the high-security storage of precious metals and other valuable assets. These are not banks. They are purpose-built vaults and are often referred to as private vaults. This option is generally considered the most secure. These facilities employ state-of-the-art security systems, are managed by professionals, and are subject to regular, independent audits. A key feature of these depositories is that they offer fully insured storage. The insurance is typically included in the storage fee and covers the full market value of your holdings against theft, damage, or loss. When you use a depository, you can often choose between allocated and segregated storage. Allocated storage means your metal is stored in a communal vault with other clients' metals, though you own a specific, recorded amount. Segregated storage means your specific coins and bars are held separately from all others, often in their own sealed container. The primary considerations for this level of service are cost and access. Depository storage is typically the most expensive option, with annual fees calculated as a percentage of the total value of the assets being stored. Access can also be less convenient than a local bank, as these facilities are not located in every city. Due diligence is also crucial. Before using a depository, it's vital to research the company's reputation, understand its insurance policy in detail, and review its auditing procedures. In conclusion, storing physical gold is not a one-size-fits-all situation. Home storage offers maximum control and access, but places the entire burden of security and insurance on you. A bank safe deposit box provides excellent security against theft at a low cost, but comes with access limitations and a critical need for separate insurance. A third-party depository offers the highest level of security and integrated insurance, but at a higher cost, and with potentially less convenient access. The decision rests on an individual's personal comfort level with risk, their need for access, and the value of the assets they seek to protect. In our next chapter, we will transition from the physical aspects of gold ownership to the financial and regulatory side. We'll provide an educational overview of the tax implications of buying, holding, and selling gold in the United States. Thank you for joining us. Welcome back. In our journey so far, we've explored the history of gold, the forms it takes, how it's purchased, and how it can be stored. Now we arrive at a topic that is fundamentally important for anyone owning any type of asset: taxation. This chapter will provide a general educational overview of how the Internal Revenue Service, or IRS, typically treats physical gold for tax purposes in the United States. Before we proceed, we must state this in the clearest possible terms. This information is for educational purposes only, and is not tax advice. We are not tax professionals, CPAs, or attorneys. Tax laws are incredibly complex, subject to change, and an individual's personal situation can dramatically affect their tax obligations. You must consult with a qualified and licensed tax professional for advice tailored to your specific circumstances. Do not make any financial decisions based solely on the information presented here. With that critical understanding, let's explore the framework. The single most important concept to grasp is how the IRS classifies gold. For tax purposes, physical gold bullion and coins are categorized as collectibles. This is the same category that includes assets like rare art, antiques, and valuable stamps. This classification is key because collectibles have a different set of tax rules than other common investments like stocks or bonds. First, let's touch upon the act of buying gold. At the federal level, there is generally no tax imposed when you purchase gold. However, taxation at the state level is a different story. Some states charge a sales tax on the purchase of precious metals, while many others do not. These laws vary widely and can sometimes depend on the total value of the purchase. It is the responsibility of the individual to be aware of the specific sales tax laws in their own state or locality at the time of purchase. The primary taxable event occurs when you sell the gold for a profit. This profit is known as a capital gain. A capital gain is the difference between your selling price and your cost basis. Your cost basis is, simply put, the original purchase price of the asset, including any premiums or fees you paid to acquire it. This is why keeping meticulous records of all your purchases, what you bought, when you bought it, and exactly what you paid, is fundamentally important. The amount of tax you might owe on a capital gain depends on how long you held the asset. This divides the gain into two categories, short-term and long-term. A short-term capital gain occurs if you sell the gold after holding it for 1 year or less. In this case, the profit is typically taxed at your ordinary income tax rate, which is the same rate applied to your wages or salary. A long-term capital gain applies if you sell the gold after holding it for more than 1 year. For most assets, like stocks, long-term capital gains are taxed at preferential rates, which are often lower than ordinary income rates. However, because gold is classified as a collectible, it is subject to a special, higher long-term capital gains tax rate. The federal tax rate for long-term gains on collectibles is capped at a maximum of 28%. This means that while the rate could be your regular income tax rate if it's lower than 28%, it will not go higher than 28%, even if you are in a higher tax bracket. This is a significant difference from the 15% or 20% top rates that apply to most other long-term investments. It's also worth noting that for certain higher-income individuals, an additional 3.8% net investment income tax may also apply to capital gains, but the rules surrounding this are complex and are best discussed with a tax professional. Finally, let's briefly touch on reporting. When you sell precious metals to a dealer, the transaction may be reportable to the IRS. In certain situations, specifically when selling particular types of products in specific quantities, for example, selling at least 1 kilogram of gold bars, a dealer is required by law to file a Form 1099-B with the IRS. This form reports the proceeds of the sale. This is not a universal requirement for all sales, but it's an important part of the regulatory framework to be aware of. Additionally, any business that receives more than $10,000 in cash or certain cash equivalents in a single transaction or related transactions is required to report it to the government on Form 8300. This rule is part of anti-money laundering regulations and applies to all businesses, including precious metals dealers. In summary, the key educational takeaways are these. The IRS classifies physical gold as a collectible. Profits from selling it are subject to capital gains tax. If held for more than a year, these gains are taxed at a special long-term collectibles rate capped at 28%, which is different from the rate for stocks. And finally, diligent record-keeping of your purchase price is essential for accurately determining any potential capital gain. We will end this chapter by repeating our most important point. This has been a simplified, high-level overview for informational purposes only. Do not interpret this as tax or legal advice. Please, consult with a qualified CPA or tax attorney to understand how these complex rules apply to your unique financial situation. In our next chapter, we will broaden our perspective, comparing gold to other major asset classes to better understand its potential role in a diversified portfolio. Thank you for joining us. Welcome back to Understanding the Basics of Gold Investment in the U.S. Having journeyed through the reasons for gold's value and the practicalities of owning it, it's now time to place gold in a broader context. An asset's characteristics are often best understood when compared to others. So today, we will provide an educational comparison of gold against other major asset classes: stocks, bonds, real estate, and cash.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
As we begin, we must reinforce our core principle. This is for informational and educational purposes only, and is not investment advice. We are not recommending any particular asset or allocation strategy. The goal is simply to highlight the different features of each asset class to foster a deeper understanding of the financial landscape. Every individual's financial situation is unique, and decisions should only be made after thorough personal research and consultation with a qualified financial advisor. Let's begin with a very common comparison: gold versus stocks. Stocks, or equities, represent a share of ownership in a publicly traded company. The value of a stock is primarily tied to the company's ability to generate earnings and grow its profits. Well-established companies may also distribute a portion of their profits to shareholders in the form of dividends, providing a potential income stream. Historically, stocks are associated with economic growth and are often considered a risk-on asset, tending to perform well when the economy is expanding. Gold, in contrast, is a tangible commodity. It doesn't represent ownership in a business and generates no earnings or profits. Consequently, gold pays no dividends or interest. Its value is determined by a different set of factors: global supply and demand, the strength or weakness of currencies like the US dollar, inflation expectations, and geopolitical uncertainty. Because of these different value drivers, gold is often perceived as a risk-off or safe haven asset. This leads to an important concept: correlation. Historically, the price of gold has often shown a low or even negative correlation to the stock market, meaning its price may move independently of, or in the opposite direction to, stocks during certain periods. Next, let's compare gold versus bonds. Bonds are essentially a loan made by an investor to an entity, typically a corporation or a government. In return for the loan, the issuer pays the investor periodic interest payments, known as coupons, over the life of the bond, and returns the principal amount at maturity. High-quality government bonds are generally considered to be lower risk than stocks, and are often included in portfolios for capital preservation, and to generate a steady, predictable income stream. The most obvious difference is that gold provides no such income or yield. Holding an ounce of gold today will result in holding 1 ounce of gold a year from now, nothing more. The comparison, therefore, often revolves around the concept of a store of value, particularly in different interest rate environments. When interest rates on high-quality bonds are high, the opportunity cost of holding a non-yielding asset like gold is also high. However, during periods of very low, or even negative real interest rates, that is, when the rate of inflation is higher than the yield on bonds, the argument for gold as a store of value is often seen as more compelling by some market observers. Now let's look at gold versus real estate. Like gold, real estate is a tangible, physical asset. Both are often considered as potential hedges against inflation, as the prices of both property and gold may rise along with the general cost of living. However, the practical differences are immense. The most significant is liquidity. Gold is highly liquid. Bullion can be bought or sold very quickly, close to the prevailing market price, in a global market that operates nearly 24/7. Real estate is one of the most illiquid assets. Selling a property can take months and involve significant transaction costs, including agent commissions, closing costs, and taxes. Another key difference is divisibility and management. Gold is easily divisible. You can buy or sell as little as a gram or a single 1-ounce coin. It's impossible to sell the bathroom of your house. Furthermore, real estate requires active management, including maintenance, property taxes, insurance, and for rental properties dealing with tenants. Gold, on the other hand, is a passive asset whose only real requirement is secure storage. Finally, let's compare gold versus cash. Cash, held in a bank or as physical currency, is the ultimate form of liquidity and offers stability of principal in nominal terms. A dollar is always a dollar. However, its greatest weakness is its susceptibility to inflation. Over time, inflation steadily erodes the purchasing power of cash. What a dollar can buy today, it will buy less of in the future. This is where the fundamental argument for gold comes into sharpest relief. As we discussed in our first chapter, one of the primary reasons people have valued gold for centuries is its perceived ability to act as a long-term store of value and preserve purchasing power. Because its supply is finite and cannot be increased by government decree, it is not subject to the same debasement risk as fiat currencies. While its dollar price can be volatile in the short term, the historical case for gold is that it holds its real value over long periods in a way that cash does not. In conclusion, every asset class has a unique profile. Stocks offer growth potential and income through ownership and enterprise. Bonds offer predictable income and relative stability. Real estate is a tangible asset that can provide income but is illiquid and management intensive. Cash provides liquidity but loses value to inflation. Gold is a tangible, liquid, passive asset that produces no income but has a multi-millennial history as a store of value, often behaving differently from these other financial assets. Understanding these distinct roles is a key step in developing a comprehensive financial education. In our next chapter, we will examine the other side of the coin, the potential risks and criticisms associated with gold. Thank you for joining us. Hello and welcome back to our series. So far, we have explored the historical significance of gold, the various ways to own it, and how it compares to other major asset classes. To maintain a balanced and comprehensive educational perspective, it is crucial that we dedicate time to the other side of the conversation. Every asset, without exception, has potential risks, drawbacks, and criticisms. Today, we will explore these aspects as they relate to gold. As always, we must begin with our essential disclaimer. This chapter is for informational and educational purposes only. It is not financial advice. The concepts discussed here are general in nature and are not a recommendation to buy, sell, or avoid any asset. Understanding risk is a personal journey, and we strongly encourage consultation with a qualified financial professional to discuss your individual circumstances. Perhaps the most significant criticism leveled against gold as an investment is its lack of income generation. As we've mentioned before, gold is a non-yielding asset. A stock may pay a dividend, a bond pays interest, and a rental property generates income. An ounce of gold, however, does not produce anything. It sits inert. This means the only way to realize a return from gold is through price appreciation. That is, selling it for a higher price than you paid for it. This lack of cash flow is a primary reason some prominent long-term investors are critical of gold, arguing that productive assets that generate earnings are superior vehicles for wealth creation over time. This leads directly to the concept of opportunity cost. Opportunity cost is the potential return you forego when you choose one investment over another. By holding a non-yielding asset like gold, an individual is giving up the potential dividends, interest, or rental income they could have earned from stocks, bonds, or real estate during that same period. When other assets are performing well and generating strong returns, the opportunity cost of holding gold can be significant. Another key risk to understand is price volatility. While often labeled as a stable or safe haven asset, the price of gold can and does fluctuate, sometimes significantly, especially in the short term. The price of gold is influenced by a complex web of global factors: interest rate changes, currency fluctuations, central bank policies, and speculative trading in the futures markets. This can lead to periods of high volatility where the price can experience sharp upswings and downturns. Therefore, it is important to recognize that, like any market-traded asset, its value is not fixed and can go down as well as up. If one chooses to own physical gold, there are also tangible costs and risks to consider. As we discussed in a previous chapter, storage and insurance are not free. Whether you use a high-quality home safe, a bank safe deposit box, or a third-party depository, there are associated costs. While these costs may seem small on an annual basis, they can add up over many years, creating a small but constant drag on the asset's overall performance. This is a cost that does not exist when holding a stock or a bond in a brokerage account. Furthermore, physical gold carries a unique risk of theft or loss. While this risk can be mitigated with proper storage and insurance, it is a consideration that simply doesn't apply to digital or paper assets. Finally, it's worth noting that while gold has a long history as a store of value, its performance as an inflation hedge is a subject of ongoing debate. While there have been historical periods, such as the 1970s in the United States, where the price of gold rose dramatically during a time of high inflation, this correlation is not always consistent. In other periods, the price of gold has not kept pace with inflation, or has even declined. Its performance can be influenced by many other factors, and it is not a guaranteed or automatic hedge against rising consumer prices in all economic environments. In summary, a balanced education on gold requires acknowledging its potential downsides. It does not generate any income, which creates an opportunity cost. Its price can be volatile. Owning the physical metal involves carrying costs for storage and insurance. and its effectiveness as an inflation hedge is not guaranteed in all circumstances. Understanding these risks and criticisms is just as important as understanding the potential benefits, as it allows for a more complete and nuanced perspective. In our next chapter, we will shift our focus to the global stage, exploring the role that gold plays for central banks and national governments around the world. Thank you for joining us. Hello and welcome back. In our last chapter, we took a balanced look at the potential risks and common criticisms associated with gold. Now we are going to shift our perspective dramatically, from the lens of an individual to the grand stage of global finance. To truly understand gold's place in the modern world, we must explore the role it plays for the largest players of all, nations and their central banks. As with all chapters in this series, please remember that this discussion is for educational and informational purposes only, and should not be considered financial advice. Our goal is to provide context and understanding, not to guide personal investment decisions. First, let's quickly define our terms. A central bank, like the Federal Reserve in the United States, is the institution responsible for managing a nation's currency, monetary policy, and financial stability. To do this, they maintain foreign reserves. These are assets held by the central bank, consisting primarily of foreign currencies, with the US dollar being the most common, as well as government bonds and, significantly, physical gold. For decades after World War II, many central banks were net sellers of gold. However, since the financial crisis of 2008, that trend has decisively reversed. Today, central banks are among the largest and most consistent buyers of gold in the world. So why do they do it? There are several key reasons, and they echo some of the themes we've already discussed, but on a massive scale. The first and most cited reason is diversification. The reserves of many nations are heavily concentrated in assets denominated in US dollars. By adding gold to their reserves, central banks reduce their reliance on a single currency, spreading their risk across different types of assets. This is a classic principle of risk management. The second reason is safety and risk mitigation. Government bonds, which make up a large portion of reserves, carry what is known as counterparty risk or credit risk, the risk that the issuer could default on its debt. Gold, as a physical asset held in a vault, has no counterparty risk. Its value does not depend on any government's promise or ability to pay. In an uncertain world, this makes gold an asset of ultimate safety in the eyes of many reserve managers. This ties into gold's role as a hedge against geopolitical and economic uncertainty. During times of international tension or financial crisis, gold has historically been seen as a safe haven asset. It is not tied to any single country's political or economic fortunes. For a government, holding gold can be a form of insurance against the worst-case scenarios, providing stability when other assets may be volatile. Fourth, gold is held as a long-term store of value. Central banks are tasked with preserving their nation's wealth for future generations. While the value of fiat currencies can be eroded over time by inflation, gold is widely perceived to preserve its purchasing power over long horizons. By holding gold, central banks aim to protect the real value of their reserves from debasement. To give you a sense of scale, let's look at a global snapshot. According to publicly available data from mid-2025, the United States remains the world's largest official holder of gold, with over 8,100 metric tons. Other major holders include Germany, Italy, and France. In recent years, countries like Russia and China have also been very significant accumulators of gold, steadily adding to their official reserves. The fact that the world's most powerful economies continue to hold thousands of tons of gold in their vaults speaks volumes about the enduring role it plays in the international monetary system. The trend of central banks being net buyers is perhaps one of the most significant developments in the gold market over the past 15 years. This sustained buying, particularly from emerging market nations, reflects a broader strategic shift in the global financial order. It signals a collective effort to diversify away from a dollar-centric system and toward a more multipolar reserve landscape, where gold plays a more prominent role. In conclusion, gold is far more than just a personal asset. It is a strategic monetary asset for nations. Central banks hold it to diversify their reserves, mitigate risk, hedge against uncertainty, and preserve value over the long term. Their consistent and large-scale purchases have become a major pillar of support for the global gold market. Understanding this official sector activity provides a crucial layer of context for anyone seeking a complete education on the subject of gold. In our next chapter, we will drill down into a topic we've touched on several times: the intricate and often inverse relationship between gold and the US dollar. Thank you for joining us. Hello and welcome back to our series, Understanding the Basics of Gold Investment in the U.S. In our last chapter, we looked at how central banks around the world hold gold as a strategic asset, partly to diversify their reserves away from the U.S. dollar. This brings us to one of the most fundamental dynamics in the global financial system: the relationship between gold and the U.S. dollar. As we dive into this topic, we want to remind you that this content is for educational purposes only. It is not investment advice or a guide to market timing. The economic relationships we will discuss are historical tendencies, not guaranteed laws. For any decisions related to your personal finances, please consult with a licensed financial professional. For decades, market observers have noted a strong, though not perfect, inverse relationship between the value of the US dollar and the price of gold. Put simply, when the dollar strengthens against other world currencies, the price of gold tends to fall. Conversely, when the dollar weakens, the price of gold tends to rise. But why does this happen? The reasons are rooted in gold's role in the global market. The first and most direct reason is mechanical. Gold on the international market is priced in US dollars. Every major gold exchange in the world denominates the price of gold in dollars per troy ounce. This creates a natural inverse linkage. Think of it this way. If the value of the dollar goes up, it takes fewer of those now stronger dollars to buy the same ounce of gold. This would cause the dollar-denominated price to drop. On the other hand, if the dollar weakens, an investor needs to spend more of those less valuable dollars to purchase the same ounce of gold, causing its price to rise. A weaker dollar also makes gold cheaper for buyers holding other currencies, which can increase their demand and further support a higher price. The second reason is the competition between gold and the dollar as safe haven assets. The US dollar is the world's primary reserve currency. During times of global economic or political stress, there is often a flight to safety, where international investors sell riskier assets and seek refuge in assets they perceive as stable. The US dollar and the US Treasury bonds backed by it is the most common destination for this capital. However, as we've discussed, gold has served as a safe haven asset for millennia. Therefore, the dollar and gold often compete for this safe haven capital. If global investors are primarily concerned about financial instability outside the US, they may flock to the dollar, strengthening it and potentially weakening gold. If, however, their concerns are about the US economy itself, inflation, or the debasement of the dollar, they may choose gold instead, causing its price to rise as the dollar falls. The third major factor is US monetary policy, set by the Federal Reserve. The Fed's decisions on interest rates have a powerful effect on the dollar's value. When the Federal Reserve raises interest rates, it generally makes holding US dollars more attractive to foreign investors, as they can now earn a higher return on dollar-denominated assets like bonds. This increased demand strengthens the dollar. For gold, which pays no interest, higher rates increase the opportunity cost of holding it, making it less attractive by comparison. This combination of a stronger dollar and a higher opportunity cost tends to put downward pressure on the price of gold. Conversely, when the Fed lowers interest rates or engages in policies like quantitative easing, it tends to weaken the dollar and reduce the yield on government bonds. In this environment, a non-yielding asset like gold becomes relatively more attractive as a store of value, which can lead to a rise in its price. It is important to understand, however, that this inverse relationship is not absolute. It is a strong correlation, but not a perfect one. There have been periods, particularly during times of extreme global crisis, where both the dollar and gold have risen simultaneously as panicked investors sought safety in every available form. Furthermore, the strong and consistent buying from central banks in recent years has, at times, provided support for the gold price even when the dollar was strong, slightly altering the traditional dynamic. In conclusion, the generally inverse relationship between gold and the US dollar is a cornerstone of gold market analysis. It is driven by the mechanics of gold being priced in dollars, the competition between the two as safe haven assets, and the profound influence of US interest rate policy. Understanding this dynamic provides critical context for interpreting the movement of the gold price on the world stage. In our next chapter, we will look beyond the currency markets and examine the fundamental drivers of gold's price, the forces of supply and demand. Thank you for joining us. Hello and welcome back. In our last chapter, we examined the intricate dance between the price of gold and the value of the US dollar. Today we peel back another layer to look at the most fundamental driver of any asset's price: the timeless economic principle of supply and demand. The price of gold on any given day is the result of a global balancing act between the amount of gold being made available and the amount being sought after. As we explore these market forces, Please remember that this analysis is for educational purposes only. It is not investment advice. Our goal is to provide a foundational understanding of the gold market's mechanics, not to predict price movements. All investment decisions should be made in consultation with a qualified financial professional. Let's begin with the supply side. That is where the world's gold comes from. The total supply of gold in any given year is made up of two primary components. The first and largest source of new gold is mine production. Gold is mined on every continent except Antarctica. In a complex and capital-intensive global industry, major gold-producing nations include China, Russia, Australia, Canada, and the United States. It's important to understand that mine supply is relatively inelastic, meaning it cannot be increased quickly. Discovering a new gold deposit, securing permits, building the infrastructure, and beginning production can take a decade or more. This means that even a sharp rise in the price of gold doesn't lead to an immediate surge in new supply from mines. The second major component of supply is recycled gold. This is existing gold that re-enters the market. The most significant source of recycled gold is old jewelry, often sold through cash-for-gold businesses. Another source is the recovery of gold from obsolete technological and industrial products. The flow of recycled gold is often very sensitive to price. When gold prices are high, it creates a greater incentive for individuals to sell their old jewelry, which can bring a significant amount of supply back into the market. Now let's turn to the other side of the equation, demand. Gold demand is incredibly diverse, originating from four distinct sectors, each with its own motivations. Historically, the largest single source of annual gold demand has been jewelry fabrication. In many cultures, particularly in large markets like India and China, gold is not just an adornment but an essential part of cultural traditions, weddings and festivals, as well as a primary form of household savings. This demand, however, is often price-sensitive. When gold prices reach very high levels, demand for jewelry can soften as consumers postpone purchases. The second, and often most influential, driver of price is investment demand. This includes the purchase of physical gold bars and coins by individuals, as well as institutional buying through vehicles like gold-backed exchange-traded funds, or ETFs. This category of demand is driven by the factors we've discussed throughout this series. Concerns about inflation, economic or political uncertainty, currency fluctuations, and changes in interest rates. While jewelry demand tends to be slow and steady, investment demand can be highly volatile, surging or retreating quickly, and causing significant short-term price movements. Third, as we explored in a previous chapter, is demand from the official sector, which means central bank buying. For more than a decade, the world's central banks have been consistent and significant net purchasers of gold. Their strategic buying to diversify reserves has become a powerful and stabilizing source of demand in the modern gold market. The fourth category is demand from technology and industry. Because gold is an excellent conductor of electricity, does not corrode, and is highly malleable, it is a critical component in a wide range of applications. It is used in the circuitry of high-end electronics like smartphones and computers, particularly with the growth of AI-related technologies. It is also used in dentistry, for thermal shielding in the aerospace industry, and in various medical devices. While this sector represents a smaller portion of total demand compared to jewelry and investment, it is a steady and essential source of consumption. The daily price of gold is ultimately the result of these forces interacting. The relatively slow-moving, inelastic supply from mines and recycling meets the diverse and fluctuating demand from jewelers, investors, central banks, and industry. When investment demand surges due to a global crisis while mine supply remains flat, the price is pushed upward. Conversely, if high prices cause jewelry demand to fall and recycling to increase, it can put downward pressure on the price. In conclusion, the price of gold is not arbitrary. It is a reflection of a complex, global interplay between its limited supply and its uniquely diverse sources of demand. Understanding these fundamentals is key to appreciating the forces that shape gold's value in the world economy. In our next chapter, we will discuss various philosophies and strategies that people consider when thinking about gold's role within a broader financial plan. Thank you for joining us. Hello and welcome back. We have journeyed through the what, why, and how of gold, exploring its history, its role in the global economy, and the forces that drive its price. With this foundation, we can now turn to a more abstract but equally important topic: the different philosophies or schools of thought that guide how people approach gold. Before we begin, it is absolutely critical to state that this chapter is for educational context only. We are describing various common viewpoints, not recommending or endorsing any specific strategy. These philosophies are presented to give you a broader understanding of market perspectives. Any investment approach carries its own set of risks, and a fixed allocation does not guarantee returns or protection against loss. It is essential to consult with a qualified and licensed financial advisor to discuss what, if any, approach is suitable for your unique personal and financial situation. One of the most common philosophies is known as strategic allocation, which views gold as a form of portfolio insurance. Proponents of this long-term, passive approach do not see gold as a tool for generating rapid growth. Instead, they advocate for holding a relatively small, fixed percentage of a total portfolio in gold at all times. For example, a figure often cited in financial literature is between 5 and 10%. The primary goal of this strategy is diversification and risk management. The belief is that because gold's price often moves independently of stocks and bonds, it can act as a stabilizing agent during times of severe market stress, a financial crisis, or an unexpected geopolitical event. In this view, gold is not expected to be the best performing asset most of the time, but its value is in its potential to perform well when other assets are performing poorly, thus ensuring the overall portfolio against catastrophic loss. A second, related philosophy centers on gold's role as an inflation hedge. While the portfolio insurance approach is focused on protecting against market crises, this viewpoint is specifically focused on protecting against the loss of purchasing power. Followers of this philosophy hold gold with the conviction that over the very long term, it will maintain its real value while fiat currencies, like the US dollar, are eroded by inflation. This approach can be either strategic, holding gold permanently as a defense against long-term currency debasement, or it can be more dynamic, where an individual might increase their allocation to gold during periods when they anticipate rising inflation. A third and more active approach is known as tactical allocation. Unlike the strategic buy-and-hold philosophy, a tactical approach views gold as a tool to be used only when certain market conditions are present. A follower of this philosophy may not hold any gold for long periods. Instead, they analyze macroeconomic indicators to identify what they believe are favorable environments for gold. Some of the signals that a tactical allocator might look for include a sustained downtrend in the US dollar, falling real interest rates, when interest rates are lower than the rate of inflation, or heightened geopolitical tensions. When they believe these conditions are met, they might initiate a position in gold, and when they see the conditions reversing, they might sell it. This approach requires significantly more market analysis and carries the risk of misinterpreting signals or incorrect timing. Finally, it is important to distinguish these investing philosophies from short-term speculation. While an investor typically has a long-term outlook, a speculator is focused on profiting from short-term price volatility. Speculators often use leverage and complex financial instruments like futures and options to bet on the direction of the gold price over a matter of days, hours, or even minutes. This is a very high-risk activity that is fundamentally different from the long-term investment philosophies we have been discussing. In conclusion, there is no single, universally accepted way to think about gold. The philosophies range from the passive, long-term view of gold as strategic portfolio insurance, to its role as a specific hedge against inflation, to a more active, tactical tool used to navigate changing economic climates. Each of these viewpoints is based on a different interpretation of gold's fundamental characteristics and its role in the financial system. Understanding these different schools of thought provides a richer context for any further educational pursuits on the topic. In our next chapter, we will discuss some of the common mistakes and pitfalls that individuals might encounter when first learning about or dealing with precious metals. Thank you for joining us. Hello and welcome back. In our last chapter, we explored the various philosophies that shape how people think about gold's role in their finances. A crucial part of any comprehensive education is not just understanding the potential upsides, but also being aware of the potential challenges. Today, we will discuss some of the common pitfalls, mistakes, and misconceptions that market observers have noted over the years regarding precious metals. This chapter is designed to raise awareness of potential challenges for educational purposes only. It is not a list of rules for you to follow, nor is it financial advice. The goal is to provide a well-rounded perspective by shedding light on common errors that others have encountered. Please continue to conduct your own research and consult with qualified professionals. Perhaps the most frequently discussed pitfall is allowing emotional decision-making to take control. This often manifests in two ways: through greed and through fear. Greed can trigger a fear of missing out, or FOMO. This happens when the price of gold rises rapidly, and individuals rush to buy in, not based on a well-thought-out plan, but on the fear that they will miss out on further gains. This can often lead to buying at a market peak.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
The opposite is panic selling. When the price of gold experiences a downturn, the emotion of fear can cause individuals to sell hastily to avoid further losses, locking in a loss and abandoning their original long-term goals. Observers note that decisions driven by strong, short-term emotions are often at odds with a stable, long-term strategy. A second common pitfall is overlooking the total cost of ownership. As we've learned, the price you see quoted on the news is the spot price, but that is not the price you will pay to own physical gold. It's essential to understand the all-in cost, which includes the dealer's premium over the spot price, any applicable taxes, fees for shipping and insurance during transit, and critically, the ongoing costs of secure storage and insurance. Failing to account for these costs can lead to a misunderstanding of the true break-even point for the asset. Another significant area of confusion, often highlighted by consumer protection advocates, is confusing bullion with numismatic or collectible coins. Bullion coins and bars, as we've discussed, derive their value almost entirely from their precious metal content. Their price tracks the spot price very closely. Numismatic coins, on the other hand, are valued for their rarity, historical significance, and condition, in addition to their metal content. They are a completely different type of asset, and are often sold with extremely high premiums. A common pitfall is for an individual who is seeking exposure to the price of gold to be persuaded to buy high-premium numismatic coins, which may not suit their original purpose, and whose collectible value can be difficult to assess and recover upon resale. This leads to the fourth pitfall: an insufficient amount of due diligence on dealers. While the vast majority of dealers are reputable professionals, the industry, like any other, has bad actors. A mistake is to make a purchase without thoroughly researching a dealer's reputation, their pricing transparency, their shipping and insurance policies, and importantly, their buyback policy. A reputable dealer will not only sell you a product, but will also provide a clear and fair price at which they are willing to buy it back. Without this research, an individual risks paying excessive premiums, or dealing with a company that makes it difficult to liquidate the asset later. Finally, a fundamental misconception is having short-term expectations for a traditionally long-term asset. Gold's historical role has not been as a tool for generating quick profits. As we've seen, its price can be volatile in the short term. A common mistake is to acquire gold expecting its price to double in a year. Market history suggests that gold's perceived function is as a long-term store of value and a risk management tool over a period of many years, not months. Applying a short-term, speculative mindset to a long-term asset can lead to disappointment and poor decision-making. In summary, awareness is key. By understanding the powerful influence of emotions, accounting for the total cost of ownership, knowing the difference between bullion and collectibles, performing thorough due diligence, and maintaining a long-term perspective, individuals can navigate the subject with a much clearer and more realistic understanding. In our next chapter, we will look beyond gold's monetary and investment roles, and explore its fascinating and vital uses in modern industry and technology. Thank you for joining us. Hello and welcome back to our series. Throughout our journey, we have focused almost exclusively on gold's monetary and investment characteristics. But to have a truly complete understanding of this element, we must look beyond the vaults and trading floors and into the laboratories, factories, and even the vacuum of space. Today, we explore the fascinating and often critical role that gold plays as an industrial material in technology, medicine, and other advanced fields. As always, we present this information for educational purposes only. This chapter does not contain any financial, medical, or engineering advice. Our goal is simply to illuminate a different facet of gold's value to humanity. Gold's usefulness in these fields stems from a unique combination of physical properties that no other single element possesses. It is the most ductile and malleable of all metals, meaning it can be drawn into a wire thinner than a human hair, or hammered into a sheet so thin it becomes transparent. It is an excellent conductor of electricity, and most critically, it is chemically inert, meaning it does not rust, tarnish, or corrode. This combination makes it not just useful, but often irreplaceable. Perhaps the most significant industrial use of gold today is in electronics. Virtually every sophisticated electronic device you own, from your smartphone and laptop to your television, contains a small amount of gold. It is not used because it is valuable, but because it is reliable. Gold is used to plate connectors, contacts, and the tiny bonding wires that connect microchips to their packaging. In these critical connections, even a microscopic amount of corrosion or a slight loss of conductivity could cause a device to fail. In high-stakes applications like telecommunications infrastructure, data center servers powering the cloud and AI, or automotive safety systems, reliability is paramount, making gold the material of choice. Gold's role extends far beyond our terrestrial devices and into the final frontier, aerospace. Space agencies like NASA have relied on gold for decades. The most iconic example is the astronaut's helmet visor. A microscopically thin, transparent layer of gold is deposited on the visor, which acts as a filter. It allows visible light to pass through but reflects the vast majority of the sun's harmful infrared and ultraviolet radiation, protecting the astronaut's eyes and keeping their helmet from overheating. Furthermore, gold is used extensively as a protective coating on spacecraft and satellites. You may have seen images of satellites wrapped in a gold-colored foil. This is often a layer of mylar, or captain coated in gold. In the extreme environment of space, a satellite is simultaneously blasted by the sun's intense heat and exposed to the freezing cold of the void. Gold's incredible ability to reflect thermal radiation, up to 99% of it, makes this foil a vital component of a satellite's thermal control system, protecting its delicate electronic instruments from these wild temperature swings. The world of medicine and dentistry also relies on gold's unique properties. For over a century, gold alloys have been the premium material for dental crowns, bridges, and fillings due to a powerful combination of traits. Gold is extremely durable and can withstand the immense forces of chewing. It is biocompatible, meaning it is non-toxic and rarely causes allergic reactions in the human body. And it does not corrode in the moist environment of the mouth. In more recent times, cutting-edge medical science has begun using gold on a microscopic scale. Tiny particles of gold, known as nanoparticles, are at the heart of many rapid diagnostic tests used today, including home pregnancy tests and tests for infectious diseases like COVID-19. In these tests, the gold nanoparticles are attached to antibodies that bind to a specific target. When the target is present, the particles accumulate and become visible as a colored line, giving you the test result. This technology is also a major focus of ongoing medical research for advanced applications like targeted drug delivery and experimental cancer therapies. In conclusion, while we often think of gold in terms of currency and wealth, its physical properties give it a second, equally important identity. It is a high-performance industrial material that is essential for the reliability of our electronics, the safety of our astronauts, and the advancement of our medical technology. This industrial demand provides a fundamental layer of value to gold that is entirely separate from its role in the financial system. In our next chapter, we will turn our gaze forward and explore the potential future of gold, looking at emerging trends and developments that could shape its story in the years to come. Thank you for joining us. Hello and welcome back. Over the course of this series, we have traveled from the tombs of ancient pharaohs to the heart of modern microchips, exploring gold's enduring legacy and its multifaceted roles. For our penultimate chapter, we turn our gaze to the horizon to examine the key trends and innovations that are actively shaping the future of this ancient asset. Before we explore these developments, we must state this very clearly. This chapter discusses current, observable trends and areas of innovation for educational context only. It is not a forecast of future prices or events and must not be taken as investment advice. The future is inherently uncertain, and these trends are presented to provide a more complete understanding of the forces at play in the world today. One of the most powerful trends is the digital transformation of gold ownership. For centuries, owning gold meant holding a physical object. Financial technology, or fintech, is rapidly changing this. We are seeing the rise of digital gold platforms, which allow individuals to buy, hold, and sell fractional amounts of physical gold that is securely stored in a professional vault, all through a simple mobile application. This innovation has significantly lowered the barrier to entry, making it easier for more people to access the gold market. Taking this a step further is the concept of tokenization. This involves creating a unique digital token on a blockchain that represents direct ownership of a specific quantity of physical gold. The theoretical benefits that are being explored are enhanced transparency, as ownership can be independently verified on an immutable public ledger, and increased efficiency. Tokenization could potentially allow for the seamless, 24/7 global transfer of gold ownership, blending the tangible security of a physical asset with the speed of the digital age. A second major trend we are seeing is the continued evolution of the global reserve system. As we discussed in a previous chapter, the world's central banks have become major, consistent buyers of gold. This trend, which began after the 2008 financial crisis, has remained robust through 2025. Many market observers see this as part of a long-term strategic shift by many nations, particularly in emerging markets, to diversify their reserve assets and reduce their dependence on a single currency. The pace and scale of this official sector buying is a key development that analysts are watching closely, as it represents a fundamental change in the structure of global gold demand. Third, there is a powerful and growing focus on sustainability and ethical sourcing. In today's world, investors and consumers are increasingly demanding to know where their products come from and how they were produced. This has brought the principles of ESG, environmental, social, and governance, to the forefront of the mining industry. We are seeing a significant push for greater supply chain transparency, using technologies like blockchain to trace gold from the mine to the final product to ensure it is conflict-free and sourced responsibly. Furthermore, there is a major drive towards more environmentally friendly mining practices, including the use of renewable energy to power mine sites and the development of less toxic methods for extracting gold from ore. Finally, the fourth key trend lies on the frontier of scientific application. As we learned in our last chapter, gold is a critical industrial material. The future may see this demand grow, driven by advances in nanotechnology. Researchers are actively exploring the use of gold nanoparticles for increasingly sophisticated applications, from creating more sensitive medical diagnostic tools to pioneering new methods for targeted drug delivery in cancer therapy. Beyond medicine, gold is also being researched as a powerful catalyst for green technologies, such as converting carbon dioxide into useful fuels and chemicals. While still in early stages, these innovations could potentially open up entirely new sources of industrial demand for gold in the long term. In conclusion, while gold is one of the world's oldest assets, it is far from static. It is being actively reshaped by the forces of the 21st century. The digitalization of finance, a shifting geopolitical landscape, a global demand for sustainability, and relentless scientific innovation. These trends ensure that the story of gold continues to evolve. In our final chapter, we will bring our journey to a close by summarizing the key lessons and foundational concepts we have covered throughout this entire series. Thank you for joining us. Hello, and welcome to the final chapter of our series, Understanding the Basics of Gold Investment in the U.S. We have traveled on an extensive journey together, from the dawn of civilization to the frontiers of nanotechnology, all through the lens of a single, remarkable element. The purpose of this concluding chapter is to connect the dots, weaving together the key principles and foundational concepts we have explored, to leave you with a clear and cohesive understanding of gold. Our goal from the very beginning was not to advocate for or against gold, but to provide a comprehensive, unbiased, and foundational education. Today, we will summarize that education. First, we learned about the dual nature of gold. This is perhaps the most important concept to grasp. On one hand, gold is a financial and monetary asset. It has a 5,000-year history as a store of value, a medium of exchange, and a symbol of wealth. This history has cemented its role in the modern world as a potential safe haven asset, a tool for portfolio diversification due to its low correlation with stocks and bonds, and a hedge against uncertainty for many individuals and governments. On the other hand, gold is a vital physical commodity. As we explored, its unique properties of conductivity, incorruptibility, and malleability make it an irreplaceable component in some of our most advanced technologies, from the life-saving devices in medicine to the satellites exploring our solar system. This industrial demand provides a fundamental baseline of value for the metal, completely separate from its role as an investment. We also learned, however, that it is a non-yielding asset, it pays no interest or dividends, and its price can be volatile. Next, we delved into the key drivers of the gold market. We saw that the price of gold is not arbitrary, but the result of a global interplay of supply and demand. We learned that supply is constrained, coming primarily from slow-to-develop mine production and price-sensitive recycling. We then explored the diverse sources of demand, which include jewelry, technology, and two major financial forces: investment demand from the public and strategic buying from the world's central banks. We also examined the critically important and generally inverse relationship between the price of gold and the value of the US dollar. Our journey then took a practical turn as we covered the realities of ownership. We distinguished between the different forms of gold, from holding a physical coin in your hand to owning shares in a gold-backed ETF. We stressed the importance of due diligence, understanding the total cost of ownership including premiums, and having a well-researched plan for secure storage and insurance. We also shed light on the unique tax treatment of gold in the United States, where it is classified as a collectible by the IRS, which is a crucial piece of information for anyone considering the asset. Throughout this series, we have aimed to build a layered understanding, moving from the historical why to the practical how. We've examined gold from the perspective of an individual, a central bank, and an industrial engineer. We've looked at its perceived strengths and its documented risks. And that brings us to our final and most important point, the core message of this entire series. The purpose of this journey has been education. In a world of loud opinions and constant financial noise, a solid foundation of knowledge is the only true starting point. Understanding an asset's history, its role in the global economy, what drives its price, its potential benefits, and its inherent risks is not just helpful, it is essential. We will close this series by restating our most important message one last time. This content has been for educational and informational purposes only. It is not and should never be considered financial, investment, legal, or tax advice. We are not financial advisors, planners, or tax professionals. All investments carry risk, and past performance is no guarantee of future results. Before making any financial decisions of any kind, it is absolutely essential that you conduct your own thorough research and consult with a qualified, licensed professional who can understand your unique personal circumstances, risk tolerance, and goals. Your financial future is your own. We hope this series has provided you with the knowledge and context to continue your educational journey with confidence. Thank you for your time and attention.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.